Thank you, guys. That was helpful. So, Ron, you alluded to a potential performance trade-off around investment performance versus social impact. And I think you said it doesn't need to be a full market return, but it does need to be some return. Love the perspective of the panel. Is that trade-off, and that's written about in the press, that people aren't willing to trade off performance for these types of investments. I think that the JP Morgan study was a little split. Half the people wanted full market returns or more, the other half were willing to compromise. What are you seeing in your businesses, and how do you think, is it a real trade-off? Does it need to be a real trade-off? And how do you find that your clients are thinking about that issue?
I certainly imagine that there's a spectrum, right, where with what we do in putting together 40 stocks in a relatively concentrated portfolio that goes out and competes with the S&P 500. What we're bringing to the table, people need us to beat the market on that. We can't go into a consultant or an advisor or even a direct shareholder and say, hey, we didn't beat the market this year, but let me tell you about this proxy we voted or a couple activities we did. So for what we do, it is absolutely essential that we beat the market. And this is actually I feel like we're to a certain extent on the front line, because we get called into a lot of meetings with consultants, and whether they're working with a Taft-Hartley plan, which is a union retirement plan, or any large corporation, these large buckets of money. And that's really where a lot of these assets are in these large pension funds. And consultants will come to us and they'll call us up and they'll say, hey, we're looking to fill a spot for a large cap U.S. stock mutual fund, and maybe we're using Fidelity or Dodge & Cox or Capital Research, any of these other large funds, and they look at us, they like what we do, and they see that we do responsible investment. And more often than not, we get skepticism from those consultants, and that's something that we fight this probably once a week. There's a story that either it's me personally meeting with the clients or our sales team doing this, and it's very important for us to drive home this message that this is an alpha generative approach. We view this as an advantage. We're surprised that other people don't look at ESG factors. Why wouldn't they? They are important for the performance of the companies that we're investing in. So that's how we view it, and we've gotten good reception from the market on this issue. But it's a very crucial issue, I think, to define kind of where you are in that spectrum.
Yeah, I would say we almost definitionally see the whole spectrum of folks, even within some clients. So within some private clients, they'll have a bucket of just wanting to make sure, number one, they don't own things they hate. Two, that for the sort of things that are expected to perform in line with conventional market benchmarks, that the percentage of those that are advancing impacts they care about is significant and rising. And so that's really looking for sort of equivalence. And then often there's a carve out for the things that are really issues they're deeply passionate about, where they are, whether they have to or don't have to, they're willing to give up return on a risk-adjusted basis. And I think that clarity of what are you trying to do, what does the opportunity set look like, I think back even to some of the metrics. I mean, as Ron was saying, really understanding the dynamic of, is there a trade-off, is there not, a lot of time gets into the business model. So to use a Haas example, one of our investees is a company founded by two Haas graduates called Revolution Foods. Great company. So when you really look at serving healthier school lunches to low-income kids, and when you look at their business model, one of the questions is, are they just going to go up market? And so when you look at, because right now they're serving 80% of the kids they serve qualify for free and reduced lunch. So low-income kids, often in underserved communities. So when you look at their business model, their economics at a site level are better for schools with high free and reduced lunch populations, because it means school lunch participation rates are higher and more consistent, which means, at a wealthy school, if it's sunny outside, people go to Taco Bell. If it's not, they eat at school. That wreaks havoc with their supply chain. So when you really dig under the covers, often it gets down to that business model to figure out is, does their mission reinforce their business model, or does it push against it? And really kind of understanding it helps get to the right answer to those questions.
So it's interesting to me that within the private debt and equity space, there are kind of two camps, if you will. There is a camp of people that fervently believe that private debt and equity impact investments should be delivered at market rates, and that if you're getting less than a market rate, then you really got fundamentally what's more a grant than an investment. And on the other hand, there are those that fervently believe that private debt and equity impact investments should be delivered at below market rates, and that if you're earning a full rate of return, you're probably not having the level of impact that you should. So in our foundation, we actually bridge both sides of that. And I'll just share one example, microfinance. So we provide debt to a microfinance bank in Peru at what I consider to be a full risk-adjusted market rate. It's a robust market. The market and the company are both at scale, and the market and the company can both support full market rates. We also provide financing to a network of microfinance banks in the Democratic Republic of the Congo. Much riskier, not developed, not at scale. We're doing it at far below what a market rate would be, certainly taking into account the risk in that country, but we're doing it because we believe in the impact of trying to build out that market so that hopefully 5 or 10 years from now, that market will be robust and developed enough to be able to support a full market rate. So when people ask me, should it be full market or not full market, my answer is it should be both, and it really depends, to John's point, on what you're trying to accomplish, where you're trying to accomplish it, and what you need to do to create the impact that you want.
All right, so I'm going to talk about impact. I'm going to put these on. So I was the investment strategist for the founder of eBay, Pierre Omidyar, for a while, and we did an analysis of what is the market for financial institutions, appropriate cost of equity for a past 10 years. And what we found was the volatility of publicly owned banks globally was very high, and the volatility of locally owned banks, each individual country around the world, was very low. And that the return from those public banks was sort of about a net zero for that time period, whereas there was a positive return for the privately owned local banks. And so this whole question about risk versus return and what's a market rate return, so one of our clients says, who knows what a market rate return is? I know what a good return is relative to the risk that I want to take. So we did this analysis, we did this whole debate last fall called Vice versus Nice. So we took the Vice fund, and there actually is a Vice mutual fund, much different than the Parnassus Mid-Cap Fund. It's very different than the Parnassus Workplace Fund, which takes the best companies to work for and selects from that list, which has been a very attractive performer on an alpha basis. And we compared that to Portfolio 21. So Portfolio 21 is a live mutual fund that you can go and see what's in there. They focus on eco-efficient products. And the Vice Fund focuses on guns, alcohol, tobacco, and gaming. And by the way, I should just take a quick point out to say I'm a registered investment advisor, so this is just for your education. These are not investment recommendations. So when you map the Vice Fund and the Portfolio 21, and they started about the same time in the early 2000s, but when you map them for the exact same time frame, and you do that on Google Finance, you can go home and do it. So it's PORTX and VICEX, and you can compare them. They have about the similar trajectory, and they both beat the S&P 500 over that time period. The interesting thing is when you look at the alpha, as Ben talks about, the alpha is higher for Portfolio 21 because the volatility is lower, the up and down is lower, and the volatility for the Vice Fund is higher. And so both have a similar outperformance on a gross basis. But Portfolio 21 has a much higher alpha because it encounters less risk. So one of the things I ask you to do for homework, there's this thing called the Crash Course. You can check out crashcourse.com. It's by this guy, Chris Martenson, lives on the East Coast. And he basically goes through all the risks that are coming for the next 10 to 20 years. And one of the things he'll repeat over and over again is the risks of the next 20 years are nothing like the risks of the past 20 years. And so when people start talking about market return and risk, you'll, if you talk to somebody like Cambridge or Fiduciary, they'll talk about tracking error. And so tracking error is historical risk and volatility. So the question you should ask your advisor or your financial manager is, what makes you think you can project future risk based on historical risk? Because that's how a lot of people do it. Not everybody. Smart people look forward, not just backwards. And so really dig into this issue for your own portfolio and ask these tough questions. So last thing I want to say about this is, what's the right market price? There is not a price for carbon. There is almost not a price for water in most regions of the world. Coca-Cola uses 2.7 liters of water for every liter of Coke. So every time you drink a Coke, you're drinking 3 liters of water that has been used somewhere in the process. It's even higher for beer, which is sort of confusing. It seemed that it should be lower for beer than for soda. And so what Puma has done is gone, and the shoe company has gone and done an evaluation of looking at its total carbon inside the company and 4 tiers into its supply chain and its water usage. And what it's found is 96% of Puma's water usage is back at the source at the cotton farm. And so cotton farms are so water intensive that if you're making a cotton-based product, that basically drowns out the rest of water usage in that particular supply chain. So what PricewaterhouseCoopers has done to go out with Puma, and this is part of the things that we evaluate when we connect environmental, social governance factors to financial results, is Puma makes about 200 million euros a year of profit. When you price carbon and price water, that on a yearly basis, that's about 100 million euros. So more than half of Puma's profit, and you can look this up online if you search environmental profit and loss, those are things that are not on traditional financial statements. So people as an asset, not on a financial statement. Future risk of carbon, not on a financial statement. True cost of water, not on a financial statement. So if you're building a robust, risk-resilient portfolio for the future, you need to go out and estimate these things. And that's one of the things that's missing in the market, and that's what we're all trying to do up here with our solutions.